One of the big investor questions right now is, are we in a stock market bubble? If so, is this the time that we should be reducing our stock allocations? Is a crash coming that could equal the dot-com or 2008 crashes? Well, I always like to keep track of how the big investors are seeing the market right now, and it seems that the big investors are divided. Ray Dalio is one of the top investors in the world. He has built a $20 billion fortune and he runs the world's largest hedge fund. Now, Ray has recently published a piece of work called Are We in a Stock Market Bubble?, which included some excellent analysis on previous big bubbles and where he thinks we are right now. So, for your convenience, I have turned this analysis into a video to make it nice and easy to go through so we can all understand what is going on right now. And here's the cool thing. The great benefit to us is that this has been done by Ray Dalio and his team of world-class analysts. And we get to peek behind the curtain and see how the professional hedge funds are seeing the stock market right now. And so, in this video, we will be looking at the 6 bubble indicators. These are the 6 indicators that Ray Dalio assesses for stock market bubbles. We'll then answer the question, are we in a bubble right now? We'll then get Ray Dalio's own personal opinion on the matter, and then we'll finish with a bit of a bonus, which is Ray Dalio talking through his different indicators. As always, if you do find anything useful in the video, be sure to drop a like, as that's always appreciated, and thank you to everyone who does. Okay, so does Ray Dalio think we are in a stock market bubble? Let's find out. So these are Ray Dalio's 6 bubble indicators that he uses to look for stock market bubbles. And they are: number 1, how high are prices relative to traditional measures? Number 2, are prices discounting unsustainable conditions? Number 3, how many new investors have entered the market? Number 4, how broadly bullish is sentiment right now? Number 5, are purchases being financed by high leverage? And number 6, have buyers made large extended forward purchases? And then he backtested these 6 bubble indicators against some of the biggest bubbles in the last 100 years. So, starting with the 1929 bubble, these were the indicators. So at the time, how high were prices relative to traditional measures? And this read as bubble. Were prices discounting unsustainable conditions? Bubble. How many new investors had entered the market? Bubble. How broadly bullish was the sentiment? Bubble. Were purchases being financed by high leverage? Bubble. Had buyers made large extended forward purchases? Frothy. So as you can see here, nearly every indicator at the time was flashing bubble. Moving on to the dot-com bubble of the year 2000. These were the indicators. How high were prices relative to traditional measures? Bubble. Were prices discounting unsustainable conditions? Bubble. How many new investors had entered the market? Bubble. How broadly bullish was the sentiment? Bubble. Were purchases being financed by high leverage? Bubble. And had buyers made large extended forward purchases? Bubble. So this time, every single indicator was flashing stock market bubble. Next, we have the 2008 financial crisis. Let's see how it measured up. How high were prices relative to traditional measures? No bubble. Were prices discounting unsustainable conditions? No bubble. How many new investors had entered the market? Frothy. How broadly bullish was the sentiment? Frothy. Were purchases being financed by high leverage? Bubble. Had buyers made large extended forward purchases? Bubble. So, interestingly, this time only 2 of the 6 were actually flashing bubble. Yet we still had one of the biggest stock market crashes of the last 100 years. And finally, right now in 2021, are we in a stock market bubble? Well, before we look at the data, let's get the opinion of Ray Dalio himself.
A lot of new ideas, new technologies, new things come along, and they make fabulous revolutions, and they grow things. And that's great. But there's a tendency of investors to extrapolate the past and and not pay too much attention to price. And when that happens, you start to emerge as somewhat of a bubble. By our measures, the bubble is not as what it was in 2000 and not what it was in 1929, but it's kind of like halfway there if I look at the types of qualities. In other words, and so what that means from a value point of view, if you're calculating, what can I realistically expect? Its expected returns shrink relative to the others. However,
So right now in 2021, how high are prices relative to traditional measures? Dalio says, only a bit frothy. And this is the data. So we do have a chart for each one of these indicators. Now, he doesn't explain the methodology behind these charts, as that is proprietary to the hedge fund. We just get to see this end result. So this particular chart goes back to 1910, and we can see it broke the 100% mark at 1929. There were some high readings throughout the year. It had broke 100% at the year 2000, and as it stands right now, we're at about 80%. So it's definitely pretty high, but not yet bubble territory. Number 2, are prices discounting unsustainable conditions? Dalio says, no bubble. And this is the data. So again, we have a very high reading in 1929, a very high reading in the 1960s. It was definitely flashing in the year 2000, and similar to the last chart, not quite in bubble territory yet, but it is very high. So to me, I wouldn't say this says no bubble. I would say this is a little bit frothy, but there you go. Number 3, how many new investors have entered the market? Dalio says, frothy. So this chart just goes back to the 1960s, which had some high readings. We can see it had broken through in the year 2000. And to me, this is getting very close to bubble territory. It's just about to break through again. And he did make a separate comment on this, saying that there is a lot of young retail investors coming into the market right now. Number 4, how broadly bullish is the sentiment right now? Dalio says, frothy. We have a reading from the 1970s, which is pretty high. Late 80s was pretty high. .com, as we saw, always reading pretty high. And again, right now, it's breaking through that 80% mark. We did have the pandemic crash here, and since then it has definitely jumped up, and especially with this new $2 trillion stimulus package, sentiment is getting pretty high right now. Number 5, are purchases being financed by high leverage? Dalio says, only a bit frothy. So here we have a big reading in the year 2000. There was quite a lot of people using high leverage in 2015. And again, right now, it's not at an absolute peak, but it's pretty high levels. And finally, have buyers made large extended forward purchases? Dalio says, no bubble. Again, strong readings in the 1970s, strong reading leading up to the dot-com crash, and this is very cyclical as you see, but I would say this is the only chart that has a very low reading. So here's a summary of where we are at right now. And interestingly, not one of the 6 indicators is flashing as bubble, only a couple as frothy. Okay, so we're going to finish with a bit of a bonus, and it's a quick 2-minute clip of Ray Dalio talking through his 7 bubble indicators. And notice this time that it is 7, not 6, as since then he must have refined the process, but see if you can spot what the extra one is.
Who knows? Is it a bubble now? So, but you can see these elements exist in the bubble phase. These are the bubble phase. Prices are high relative to traditional measures. Prices are discounting rapid future appreciation from these highs. What I mean by that is you could look at market pricing and deduce from market pricing the picture that is being painted of what the future looks like. In other words, if I look at the relation between stocks and bond yields, there's an implied growth rate.
And if I look at the relationship between inflation index bonds and nominal bonds, I can calculate what the market is discounting in the form of future inflation rate. And so there's a picture of the future. And if the future is different than that picture, that will determine the returns of asset classes. There is more broad bullish sentiment. In other words, you're walking around and everybody says, oh, this is great and it's going to go up. Then there are purchases financed by high leverage. So that's apparent, buy on borrowed money, buy stocks on borrowed money, buy whatever the asset is, buy homes or whatever it is. And then sometimes buyers have exceptionally extended forward purchases. In other words, built-in inventory. Because they're worried that it's going to go up, I have a good inventory. Or contracted for supplies because they work up. Or maybe buy an apartment to speculate that the price of the apartments are going to go up. And people in general are buying those things in that particular appreciation. And then in addition, that there are new buyers who come in. They never used to do it, but now they're attracted to it because it's a hot market. And so you see them coming up, the classic example of the tulip mania. Okay, you're coming in, I need to have tulips, and oh, it's a great thing to have. And you see that. And then you see a stimulative monetary policy that is going to inflate the bubble. And so when you see these things simultaneously, you'll see a lot of those. You can almost have that checklist, and you could check off those things. And when you start to see that, that becomes largely unsustainable. So
there you are, guys. Those were Ray Dalio's 7 indicators he uses to assess stock market bubbles. Although some of these indicators to me did look quite high, Ray Dalio does not believe we are in a stock market bubble. But then if you look again at the data from 2008, only 2 of the 6 indicators were actually showing as bubbles. And we still saw one of the biggest crashes in 100 years. If you haven't yet seen my video on how to prepare for a stock market crash, be sure to check that out here. Personally, I think it's all about being prepared. As long as we are prepared for either direction, we have a plan in place and we know what to do, we can then just relax and let the market play out and do what it's going to do. So there you are, guys. I will also keep you up to date on the opinions of other big investors, as it's always good to cross-reference what other people think. So, hope you found this useful. In fact, just one favor to ask, if you did find anything useful in the video, be sure to drop a like, as that's always very much appreciated. In fact, thank you for everyone who does. You guys are awesome. If you haven't yet subscribed to the channel, be sure to click below and join us. I do have some great videos coming up that you don't want to miss. Okay, cheers guys, thanks for watching, and I'll see you in the next video. Bye for now.